The global energy and inflation shock continues to gather pace, leaving policymakers in a most challenging position. The latest outlook globally and locally as we approach the end of financial year. Global factors continue to drive the domestic economy and decision-making for our Reserve Bank, who have finally conceded the need to act more urgently in the face of ever-increasing supply issues and price pressures. The June rate hike of 50 basis points wasn't a surprise when compared to other central banks who are also lifting rates 0.5% at a time, including the US Federal Reserve, the Bank of Canada and the Reserve Bank of New Zealand. But it was a very different message to earlier in the year when the RBA was dismissive of the need to lift rates at all. So the hard part lately has been forecasting what the RBA board would decide to do as opposed to what they needed to do. Recent RBA forecasts for CPI to peak just under 6% and core inflation not to exceed 5% appear at risk of being far too low. So the RBA was right to front-load rate hikes and act more decisively. Monetary policy is a very blunt tool, so to have any chance of slowing inflation, they needed to get ahead of the curve. Unfortunately, this tactic will impact the economy. Its aim is to reduce household demand and consumer spending, at the same time that the economy is trying to reopen, but while businesses are dealing with labour shortages and higher input costs. Fortunately, domestic demand is relatively strong, including demand for labour, with unemployment down to 3.85% and May job advertisements at another record high. So the economy was in sound shape going into this global downturn, ahead of the sharp increases in energy and commodity prices. GDP growth was a healthy 0.8% in the first quarter of the year, on top of the upwardly revised 3.6% for the previous quarter. So our economy ended up growing 4.5% in 2021 and is still expected to grow near trend this year, despite the more aggressive pace of RBA rate hikes. 2023 will see much slower growth as we try to cope with an RBA cash rate above 2%. But unlike North America and many parts of Europe that may be headed back into recession, the strength in our jobs market, the strong trade surplus and high levels of household savings should improve the chances of achieving a soft landing for our economy. Higher interest rates will impact property and equity markets and all asset values, with a decline in residential property of around 10 to 15% widely expected from peak to trough. Again, a soft landing in the context of recent price increases, but a challenging period for households to adjust to higher borrowing costs and businesses to deal with labour shortages. In the latest CoreLogic data for May, the median price of a house fell nationally by 0.1%, but with a remarkably wide range of outcomes, down 1% in Sydney and 0.7% in Melbourne, but still up impressively in the other capital cities, and up 0.5% in regional Australia in May, 22% year on year. From here, we do face a period of ongoing global uncertainty and rising interest rates and higher inflation. So, while yields on many assets may remain attractive, real capital appreciation will be much harder to achieve than during the last few decades of falling rates and benign inflation. And that's the market update from Leveraged.